Hello, everyone. Welcome to Real Estate Right Now. We talk about real estate matters that matter to you. My name is Jay Izzo, and we are live here from Linda Craft Team Studios here in Raleigh, North Carolina, part of the Greater Research Triangle Park. Today's show, headlines for the week. We went out, we researched the top headlines for the week. And I decided, that's so funny. I decided, I wanted to have somebody join me do this. And so I asked my dear friend, one of my best friends, Paul Fitz, who's been on the show, senior loan officer with Advantage Lending. And, we've just to be completely transparent, they
don't want you to be transparent.
Well, I mean, I need to be in this case. So years and years and years ago, Paul and I used to do a bunch of stuff together in terms of these little type of little radio shows and stuff we used to have fun with, and live
WOOF,
woof 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 woof,
yeah, woof,
and
bark around the park,
yeah.
WOOF.
And we had some ideas to do some shows together, and it hasn't come to fruition yet. It may. I'm not saying it won't happen. It just hasn't happened yet.
Never know.
And so I thought, when we're doing these shows, oftentimes we come in with a specific topic and we try to roll with it for about 30, 45 minutes. And one of the things that I felt that we should change this year is that every now and then we should just do what the top real estate headlines for the week in residential real estate.
I like the other idea better, but that's okay.
I know.
Yeah. I thought about doing coffee talk, 555 TALK.
Coffee,
right?
coffee
Call.
talk.
Let's talk. No big whoop.
Sure. No big whoop.
Linda Richmond.
Love that. Yeah. So we're going to talk headlines today.
Okay.
And we're going to batter these around. Please join us wherever you're watching.
You guys awake yet out there?
Yeah.
Anybody awake?
Yeah.
It's early.
Yeah, I know. And you feel you've got pollen and all sorts of stuff going on, but that's normal for
I have a spilkus in my connectozoid.
Spilkus in your connectozoid? That's awesome.
Still on coffee talk.
Still on, this is coffee talk. So let's talk about it. This comes from money.com and Freddie Mac PMMS. Mortgage rates jumped back up. 30-year fixed rate mortgage average 6.22% for the week of March 19th, which is up from 6.11% from the week prior.
Okay.
Daily surveys show even more volatility, with rates averaging around 6.4%.
It's true.
Significantly higher than February's average of roughly 6.1%.
Yep.
What do you think is affecting these rates? I know. I mean, people, every little bit makes a difference, but what do you think is affecting that?
I'd love to know what people think.
Yeah,
by the way,
I would too.
Because I haven't heard. Have you heard of the Fed making any moves?
Nothing.
You have. Wait.
No.
But I thought.
Right.
The Federal Reserve controlled interest rates, Jay. What are you talking about?
But you have said on this show repeatedly that the Fed
controls rates, man. I don't know why they're bouncing up right now.
But
all of a sudden.
The Fed has done nothing. And by the way, it is counterintuitive for everybody, because when the Fed lowers the
Fed funds rates,
when they lower their Fed funds rates,
mortgage rates
go up
every time.
Go up
every time.
Every
single time.
Every time. People don't understand that. They don't get it. So help people understand why, with zero Fed fund rate raises or lowering,
zero Fed moves.
So what is making this mortgage rate jump a little bit around?
So and again, we can sit here and discuss the Federal Reserve all the live long day as far as mortgages are concerned. And I'm still telling everybody the same story I've been telling them for 27 years. The Federal Reserve does not control interest rates.
Right.
Fed rates are still the same as they were in December. They have not moved in 3 months.
Right.
Okay. However, mortgage rates have gone down. Mortgage rates have now gone back up. And everybody's like, what is the catalyst? So it's an easy thing for me to talk about. Again, buying and selling bonds, buying and selling mortgage-backed securities. If you buy mortgage-backed securities, if you buy treasuries, if you buy bond, if you're buying our long-term debt, mortgage rates will go lower, right? I have a personal theory. I've bounced it off a few of the other economists that I know, and I personally believe that the reason why we're seeing an uptick in our mortgage rates right now is that there's dumping of bonds by other countries. Some countries are not happy about what we're doing in Venezuela
or in Iran,
or some countries are not happy about what we're doing in Iran right now.
They're dumping their bonds.
So their only form of retaliation against the U.S. is to start dumping treasuries. And I did a search the other day, and it's funny we're talking about this, but I did a search the other day. China's hold on our treasuries right now is at a 17-year low. So in other words, they've been systematically dumping treasuries. People talk about, if you're seeing yields go up, those are recessionary fears. But I really do believe that when you see yields go up and you're seeing the stock market drop at the same time, there's no influx of money going from one into the other. Somebody has to be doing something somewhere else.
Well, I mean, the money just doesn't disappear.
Doesn't disappear.
That's it's going somewhere, right?
There's no ether for money.
Yeah. I mean, it just doesn't evaporate.
Correct.
And so, I think I agree with you. I think there's a lot of factors here that play into the role of why we would see some fluctuations.
Geopolitical.
I mean, and it is, I agree with you. I do think it's largely geopolitical. I do think that you're probably, I like your phrasing better than the way I was going to phrase it, that this is, for some countries, our involvement in certain situations, this is their retaliation.
So, Venezuela sends oil to China. Iran sends oil to China.
Right.
This is not rocket science at the end of the day.
Right.
Right. They're not happy with our involvement with either country.
Right.
Therefore, this is the best way that they can have a form of retaliation. Right. And how does that affect us? Well, it squeezes on the mortgage side, right?
Yeah.
Again, the long-term trend right now will be rates will continue to decline.
Right.
We hit our peak in rates in my career. We hit our peak of rates in August of 23. Excuse me.
Right.
So we hit our peak of rates then, and since then they have been on decline. I still claim that Jerome Powell has been one of the laziest Fed chairs that I've ever seen in my entire existence, because he has tools such as QE, like he could do bond buyback programs. He could do a twist. He could do whatever. He has done nothing except look at data and say, man, maybe we should do something now. So.
And I think we need to point out to people that from that perspective, there's this over-reliance on the inflation data.
Sure.
And so what happens is if inflation's out of control, then they have a tendency to try to reel it back in through the short-term mortgage rate when he starts to bring that rate down.
That should be the goal, yeah.
But I think there's an over-reliance on that, because there's absolutely other factors that can go into that, where even though his change in rates don't immediately affect the mortgage rate,
right?
The fact of the matter is, he has room to move that rate down if he so chooses.
He's got tools at his disposal,
right,
to make an effect in our market. He has chosen to do none of that. And I'm hoping that the next Fed chair that comes in will be more like a Greenspan or a Bernanke, and actually be proactive in what we do in our market.
Well, as Greenspan said, right, he coined the term emotional exuberance, right? And we do live in an emotional market, and I think you do have to kind of keep that in mind in the back of your head, in terms of how you adjust. Instead of just looking at the data, I think you do have to look at what's happening overall with the economy, and I think that's a big deal.
Yeah, again, it's geopolitical. It's not. It's funny because in our nature, we're really just salespeople. We're out here trying to sell a product. We're trying to sell mortgages or houses. That's right. But still, if we don't know everything that surrounds our encompasses our industry, and politics has a play in what we do.
Right.
So we have to be politically aware of what's going on.
Absolutely.
To at least be able to explain when I quoted somebody in February a quarter point lower than it is today when they finally get under contract.
Right. Which it's and for them, they're going, what happened, right? And but this is some of the reasons. Headline number 2. This comes from Real Estate News Source. realestatenews.com. Homes are sitting longer. The typical home spent 66 days on the market in February, up from 58 days a year ago, and the slowest February pace in a decade. With so many more home sellers than buyers in the market, buyers have probably a better chance of finding the perfect home in the perfect neighborhood. What's your thoughts on this? Because it's a fact. We are seeing a few more days on the market. So what are your thoughts here in terms of, are we moving towards a buyer's market?
No, I think we called it on this show, though. We did it 6 months ago.
Probably.
Welcome to the buyer's market.
Yeah.
Because sellers are now paying concessions. Due diligence and earnest money is now lesser amounts than what they used to be. After the home inspection is done, there are still concessions that are being done at that point. And I think that when you have those combinations of those three things, it tells you that sellers are now trying to work better with buyers to get a property sold. So I feel like we've been in a buyer's market for at least 6 months now. It may not have felt like the buyer's market we had in the early 2000s,
right?
But we've been in a buyer's market. I think now they're just kind of saying, yeah, we're actually seeing the concessions in all of our markets versus just some of the markets. So.
Yeah, we saw, I ran across an article that was sent to me by the Triangle Business Journal that said that basically 30% of all sellers have made a seller concession.
Oh, yeah.
So that's 1 out of 3.
Every contract. Rarely do I see a contract these days. And even remember, during the real seller's market, when it was $50,000 in due diligence and we're not making repairs and we're not giving you a credit and we don't care, we'll put it back on the market. That market has completely evaporated to whereas now even, if I have a contract and even though there's not any closing costs being paid, I'm telling you, by the time the inspection is done, there's a credit being issued back to the buyer at that point. So,
yeah, I think buyers have a little more, I would say a little more leverage than they had before. I know that people get a little afraid of rates. I don't think they should be. I don't think the rate should cause you to fear. I think the fact of the matter is
rates should never be a driving factor.
You're right. But here's, we've talked about this on this program before. The fact of the matter is what people will focus on the rate,
of course,
but what they're not doing is they're not thinking about the long-term equity. Yeah, because and by the way, let's be clear here.
Paying somebody else's mortgage if you're renting somewhere.
Let's be clear here. And we're going to talk about this because it's one of the headlines. Every area is different.
Every market.
So every market's got a difference because some markets are doing quite well. Some markets have actually gone down. You just need to know your market.
Florida market has slowed down.
Yeah.
Whereas other markets, again, Florida
Austin has slowed way down.
Austin has slowed down. Again, markets that were hot for 5 years, 7 year running, they're now slowing down. Why? Because people are like, hey, you know what? I'm a remote worker. I don't have to go all the way to Florida I could go to Georgia and I could go to South Carolina, like they can understand where they can stem to at that point.
And in some of these places, and I think Florida is this case, in some of these cases, there's just not a lot to buy.
There's probably they're probably behind on their construction and what
and so there's not a lot to buy, which creates some slowdown of purchases as well.
Vacuum.
Yeah, right. There's a little vacuum. Next headline. This comes from Pro Builder and Yahoo Finance. The housing forecast 2026. Resale homes now cost more than new construction. In a reversal of decades of convention, existing resale homes are now more expensive than newly built ones. As of Q4 2025, the median resale home price was $414,900 nationally, compared to $405,300 for a new single-family home, meaning resale buyers are paying over $9,000 more. From 2010 to 2019, new homes were typically $66,000 pricier than existing ones. Nearly 2/3 of home buyers in 2025 received a discount off the list price, with the typical buyer getting a 7.9% price cut. That's the largest since 2012.
Okay.
So let's talk about this because I think sometimes numbers can be a little misleading. And I think this is that case right here.
Well, for the longest time, builders were trying to keep their price point as high as they possibly could.
Right.
Because when they're doing new construction in a neighborhood, the last thing they want to see is a decline in appraisal value.
Right.
Okay. But they may have finally seen the writing on the wall is that people are price hunting out there now versus, hey, I'll take $25,000 in seller concessions as long as I still have to pay that $425.
Right.
I'm really looking at 400. You know, I mean, again, there's a psychological barrier on that.
But I think there's another thing here too. Because we've been so concerned about first-time home buyers. I mean, some of this could be, in fact, that maybe we're building, across the country, because this is national.
Starting to build a lower price
price point. I mean, that's a possibility. I'm not saying that's happened, but I'm saying it's a possibility.
So again, it's taking the national average, right?
Right.
Okay.
And we're taking the median.
Right. So,
right. Which, by the way, for people who don't know about the different types of averages, you have 3 types of averages. You have median, mean, and mode. The mean average is if we take everything and we add it all up and divide it by the number of total people in the market, that gives us a mean average. The mode is the most common price area, and the median is the very center, meaning that you have 99 properties, and you take property number 50 because you've got 44 and above, 44 below, and you take that middle number. So as a former stats teacher in universities, I just felt it was important that we help people understand it.
No,
I have to go back. But I mean, but this is interesting because I don't know that we have a lot of explanations for it. But
I mean, you start with number one in the cities. Let's just start urban. Okay. So in the cities, you're not building 50 lots at a time.
Oh, right.
I'm being,
Right.
You're not building 50 lots at a time inside of a city where the price point will be higher than it would be anywhere around that surrounding area. So, if we're building 50 houses in Raleigh right now, then that means that in Franklin County, we're probably building 300 houses. In other words, it's a more rural setting. The acquisition of land is cheaper versus what it would be inside an urban setting, right? So when they're saying that the national price is starting to become a better price point, it doesn't necessarily mean that the better price point is still in Raleigh versus Franklinton.
Right. And I would say this, because you really made me jumpstart something else in my head. Here's the other thing. What we know from the National Association of Realtors statistics is that people look for, number one, the neighborhood, number 2, schools, and then conveniences is kind of like number 3, right?
Yeah.
So if you think about that, I want to be as close to, let's just take our Raleigh area here. I want to be as close to Raleigh as I can be.
Right.
And these neighborhoods have got their pool and they're all the amenities and everything like that. They're not building anymore. I'm in a good school district.
Right.
So it almost does make sense that a resale may be a little higher simply because you're looking for the great neighborhood, you're looking for the great school, and you want to be closer to town.
And what is going to be more of inside an urban setting? It's going to be resale.
Right.
Once you go outside the city limits and you're into, again, Wendell, Knightdale, where they're building tons of houses in Wendell, Knightdale right now, in case anybody's watching internationally. So
you didn't say Lizard Lick, so that's okay.
Hey, listen, I'm never shy on Lizard Lick property.
There is really a Lizard Lick.
Hey, look, honestly, the greatest buying opportunity in Wake County right now has to be Zebulon.
That's great buying.
I believe it's one of the last few price point opportunities that somebody could get in this county before they start going out to other counties.
Well, because a lot of people are moving to Johnson County, Franklin County,
Franklin, Harnett,
Granville.
Yeah.
I think in our area specifically, that Zebulon, Wendell, area is,
and they're growing, and they're building new construction everywhere.
Yeah,
there.
and that's the point.
And I would buy an existing property in one of those areas, because new construction is going to balloon. So.
And that is the point that you made. That's such a good one here, is that we're not building neighborhoods in town anymore.
No. Yeah.
What you and I are seeing is existing home sales. We have this area called Inside the Beltline.
ITB.
And let's just think about that for a second. What we're seeing is people buying this existing home, tearing it down, and then rebuilding it. And by the way, they're paying a premium.
They're paying $1 million for a property.
Right. Tear it down.
So they can put $5 million on top of that.
And we're seeing that in other neighborhoods within the triangle, because outside.
So why would that price point be lower now?
Right. So it only kind of makes sense, right? When we start thinking through it, that's probably
sure, of course.
Some reason.
I mean, again, they take all of the houses and they throw them into a pot and they come up with an average number, right?
Right.
And they're like, oh, well, new construction is going to be cheaper. Well, yeah, because new construction is going to be in Franklin County.
Right.
It's not going to be,
it's moving further and further out from the city areas.
That's right.
So if you're in Columbus, Ohio, which by the way is a relatively similar market to ours here,
it's not too dissimilar.
Yeah. And so
university driven,
right? There's nothing left in Columbus to buy, so they're moving further and further out of those areas.
Yep.
And of course, the prices are going to be less.
Look at the area in which I grew up here in this town. Is a little small area called Wake Crossroads. And in Wake Crossroads, every single farm where I picked tobacco is now a subdivision. So they were farms, they were fields, they were, fields of acres and acres and acres of tobacco. They are now subdivisions. Well, if you go into Wake Crossroads now and you turn on Watkins Road, almost one entire side of Watkins Road now at this point where there were homes, existing homes, they have all been torn to the ground. Developers have come in and they are going to turn that entire area of Watkins Road into one big subdivision, outer subdivision of the city of Raleigh.
Yeah.
And it's what's going on right now. Now, those price points, when they build those houses, are going to be maybe 400s, high 3s to 400s.
Right.
And if you take the exact same floor plan and you put it inside the city limits, inside of 540 at that point, then that house is going to be 700.
Right.
So why wouldn't somebody move out for just a little bit better of a price point on a house?
Great points. The fourth headline that we're going to talk about, it kind of is related to this a little bit, and this comes from Mortgage News Daily as of March 20th, 2026. It's their daily newsletter. They're talking about new home sales dropped sharply. New home sales fell to a seasonally adjusted annual rate of 587,000. Down sharply from December 712,000.
Okay.
So we're down about. So we're not only down in new home prices, but we're also new home sales have dropped, suggesting, and I don't know if this is a correct assumption or not, because whenever I hear somebody in the media say suggesting something, to me it says
sources say
we're assuming this is what happened.
Sources who are your sources? I can't.
So they're assuming that builders are selling fewer high-end homes and shifting towards more affordable prices. I don't think that's a bad assumption.
We should have been doing that anyway.
I agree.
Yeah.
But as you and I both know, the cost of materials. I had Jim Allen, who does a lot of development in this area, on the show last week.
Speaking of tear down houses and, exactly. Yeah.
But he does a ton of development all over the triangle and outside of it. And, he was saying, listen, the cost of materials is higher.
Yeah.
It just is.
Cost of labor is higher. Yeah.
Yeah. So when you think about new home sales dropping sharply, what are your thoughts on why we would see this drop from 712,000 in December to 587 in right now?
I think where you're building matters. If you're building, again, using Jim, and by the way, Jim, if you're watching, bro, I love you, man, because you're an innovator.
Oh no, my gosh, he's awesome. Yeah.
So, but let's take what Jim has done in Northridge. Northridge. He brought in developers and builders.
Right.
They're buying houses that have been there since the 80s. Right. They're paying $1 million for the lot.
Right.
And then they're putting $3 million of a new property on top of that lot. Okay.
Right.
that's where that price point is. And again, that's Raleigh. Okay.
Right.
Again, I think the majority of new construction has moved. It has to, by the way, it has to. The majority of new construction has to move further out than urban settings.
Yep.
And if it moves further out from urban settings, again, land acquisition costs are cheaper.
Mm-hmm.
The amount of lot sizes they have, like in other words, you can sell 400 acres of land in Wendell because that used to be a farm. Right. Whereas you don't have 400 acres.
Which,
of
by
land
the way,
in
there's a subdivision called Wendell Farms.
Yeah, exactly. There you go. Yeah, exactly. Yeah. Because it was a farm.
It was a farm.
Yeah. Let's make no mistake. It was a farm. But the point is that land acquisition costs are going to be cheaper the further out you go.
Right.
So again, if price points are coming down, does that say that it's cheaper to build in a setting like that's an urban setting? No, it's almost impossible.
And I agree with you, but I think the reason why these new home sales drop so sharply, I think goes again to our previous point, in that people want to be closer to the conveniences or where they work, right? And so,
what can they afford? Especially new home buyers, can they afford a $700,000 house? Or can they afford a $400,000 house?
Well, that's the thing, is that we have a lot of convoluted factors here that can contribute to
FHA
this.
loan limits. The loan limit on FHA is $540,000 right now. Builders cannot be obtuse to the fact of knowing what their loan limits can possibly be for somebody to buy a home as well.
That's a really good point. I didn't think,
they have to know what their price points are.
Right.
They're like, well, if I have a client who has a 620 credit score and not enough money to put down, I need to build that house at 550 or under so I can sell it regardless of who wants to buy it.
Well, but if you think about it, it's kind of almost an odd, because the two headlines almost contradict each other a little bit, right?
I just want you to read the article.
Well, no, think about it. So we said that resales are costing you more than new homes.
Right.
But then we go and we say new home sales are dropping sharply. Right. From last December.
Yeah.
So if new home sales are dropping and resales cost you more, so then
wouldn't that push you more towards the new home?
Well, you would think it would, but again, if the NAR statistics are true, that it's really, which I believe they are, that really people are interested in neighborhood first, school second, and then conveniences third.
Yeah.
Then it almost does kind of make sense that people were willing to pay more for a resale to be closer, to be to where they went. Maybe you wouldn't.
Yeah. No, I would. To me,
you would.
To me, there's more value in a resale property right now.
Right.
There's more value in it.
Well, okay, and I think that's a great point.
Yeah.
I think that's a really great point, because I think that the resale property, has value simply because of the location.
It's probably in a better location.
It's just in a better location.
It's probably in a more appreciating area as well.
Right.
Like, in other words, no offense to home builders, because I do loans.
No. This isn't anything. No.
But this is about, if I'm looking to move to an area, I'm probably going to look for an existing property.
Right.
Hey, it's been there. It's survived hurricanes, whatever. I mean, I've it's seen whatever. But at the same time, a house that's an existing house in whatever area, if I buy one in downtown Wilmington or downtown Raleigh or wherever I buy, I'm pretty sure that house is going to have a better appreciation value than one in Wendell.
Right.
Again, not knocking Wendell.
No, not at all.
Yeah.
Interesting stuff. Things fine. By the way, shout out to Luke Mitchell watching the show, and of course our really good friend Bob Winstead.
Bob, future Secretary of State.
Yeah, we really appreciate you guys tuning in and watching us live. Tell your friends. We always appreciate that. Little plug. Next headline. This comes from the Florida Realtors. They did some research, and it's not just Florida. They did a nationwide research. More homes are coming to the market, and they're saying inventory is up 12%. The number of homes on the market has been climbing, with active listings reaching 976,833 in December 2025. It's a 12% increase from a year earlier.
I think people are willing to let go of their 2% interest rate.
Well, okay, but you know what? We're going to hopefully we'll get to the headline, later. But because people have been locked into this three and below.
I did my job as a lender. I got you those 2 and 3% interest rates.
But this is the first time we've seen that there are more people, and this is just a few weeks ago, that more people have a rate higher than 3% than people who have a 3%.
Right.
So we're starting to see that shift. So people aren't locking in.
Right.
We'll talk about that a little bit later. I think that's absolutely a factor. But I think that there's another subtle factor here, and that is that remote work is becoming less.
Okay. I will say ish. I am still doing mortgages for people who have jobs located in LA, San Francisco, Chicago, and who are moving here because they're moving here for the affordability factor. They don't want to live in those cities.
Well, no, and we can't blame the tax rates and everything else.
Price of the house.
The price. Well, I mean, a good friend of ours. We have a good friend by the name of Jed.
Yeah.
Right, building the only thing he could really do, because his wife took a job over in California, and the only thing he could do was build a townhouse.
Yeah,
there as part of townhouse. Right, cost him a bunch of money.
Yeah,
but it was actually cheaper than renting.
I believe that.
Which was crazy.
Yeah.
It was actually cheaper than renting. So because the terms of the location where she needed to be, right? It was either you could be 10 minutes from her where she was going to work,
sure,
or you were going to drive an hour plus with traffic.
Right. Which I'm not doing.
Which nobody's doing.
I'm not doing that.
Nobody's doing that. So it really put him in a really awkward position. So I think.
So you think that remote work is starting to become less?
Well, I think we're seeing
a contraction.
RTO. I think we're seeing more return to office.
Really?
Yeah. Well, I think the more articles I read in terms of what I'm seeing from especially the bigger corporations, I don't want to say this because then this turns into a political discussion, but I got to say it anyway. What's happening?
I'm ready for that.
So oftentimes this push for return to office is because they're counting on a certain percentage of people not willing to do it, and so it's their way of being able to cut their staffing. So especially the larger corporations, it's a tool that has been used in the past.
So your 40 and 50-year-olds, people,
right.
I'm in my 50s.
Right.
Your 40 and 50-year-olds, the guys who have been working on the job, whatever field, for 20 plus years, they're telling their corporations, I'm not doing it.
I'm not doing it.
I'm 100% effective wherever I am.
Right.
I'm not doing it.
Right.
You don't like it, I'll go get a job somewhere else. Because if they know they're qualified,
or they're close enough to retirement where they're going, what, I'm not dealing with this.
Yeah. Either you want my leadership to
skills, experience, whatever it is,
or you don't. Right.
Right.
And I've seen more companies capitulate because they still want the seasoned dude. They don't want to train these kids with MBAs.
Well, the cost for many of these companies is, for loss and then recovery is well over $100,000 per person.
Per person.
So it is a lot.
So now, if you want to say that the younger generation of worker, the 20s to, let's just call it 38 at least, 22 to 40. Let's just call it that.
Okay. All right.
So your graduate all the way to about age 40, they want those guys in the office because they haven't seen enough, they haven't done enough, and they feel like those kids need to have synergy within their own office structure. And they do want the 55-year-old guy to at least come in once a week,
right?
Or at least say,
yeah. But I think the fact that we've got so many more homes coming on the market, I think also is a positive sign that says that people are now willing to relocate. Now, what this article doesn't share with us is there a particular age range? So for instance,
it doesn't talk about that.
So here's another thought process I had about this article is, the baby boomers are quite older now, but they're working longer, right? I mean,
you got to keep up with all those spoiled children.
I
got to pay Junior's bills.
I have a friend who's 87 years old,
and
still running a company, right? And at part-time running a company. And even though he doesn't have to, because he just wants to stay in the game. And I'm seeing a lot of 80-plus-year-old people.
I will never retire, by the way.
Yeah, I have no desire to.
No desire.
Yeah.
I enjoy working.
I may look like the crypt keeper, but I will still be doing the show.
You'll be the crypt microphone.
Yeah. This microphone will have cobwebs over it. All that.
Welcome, Jay.
But the point being is you have, I think, people who there are more and more of them are starting to retire.
Yeah.
And so I do think they're willing to let go to move to their dreamland, right? Get out of the city, move towards, maybe get out of the bigger cities, maybe get out of California, maybe get out of New York.
Oh, definitely.
And maybe get out of those cities and
get out of those hellholes
and move somewhere else. That was those views are not necessarily reflective of the owners of the show.
But hey, listen, I didn't create the exodus. They're coming this way.
But it is true.
Yeah.
They are leaving states like California. They are leaving states like New York, where taxes are higher, and they're looking for and they're looking for a different lifestyle. I think oftentimes what we're seeing with the older generation is that
or climate again.
The climate, yeah, right. They want a warmer climate. They're done.
Yeah.
Now,
I don't want to shovel snow. 14 times
California is awesome. Yeah. Climate-wise, it's awesome. But the expenses, I mean, are so much because the taxes are so much that people are going, listen, I can't retire here.
They're moving from LA to Henderson, Nevada. Why?
Right.
Henderson is right outside of LA, so therefore they have entertainment.
Right.
I mean, Las Vegas, so they have entertainment and whatnot.
Right.
You should see how many homes are being built in Henderson, Nevada on nothing but desert.
Which, by the way, there was a time during the Great Recession where Henderson, Nevada was a ghost town.
Yeah.
Complete ghost town.
Not now.
But not now.
No.
It was a complete ghost town. So I think there's a number of factors that contribute to why we're seeing
the older you get, the less you have, the less you're willing to tolerate the higher taxes, the congestion. You know, again, you're like, if I can do my work from wherever, I can still be effective as a director or manager or whatever else I'm being effective as at that point. Again, I don't think it diminishes what remote work does for people who are of a certain age. Okay. I actually enjoy my job. And at 57 years of age, you know, and I was in Vegas 2 weeks ago and I was taking loan applications while I was in Las Vegas, right? I can work from anywhere. I can be productive from anywhere.
Right. And you do that. Matter of fact, you and your wife both were able to be productive.
That's right. But I guess the point is for how this works for as far as home sales, or to bring it back to what we're talking about the migration and the move.
Well, because more homes are coming on the market,
right?
Which, by the way, as a buyer, that's great for you.
Yeah.
The reasons why that's happening, I think, are multiple, for multiple reasons. But I do think one of the two biggest contributors are an aging population that's moving to a place where they want to retire. I also think that we're seeing more RTO, return to the office. So those are I would think two of the biggest ones.
Now, what do you think about as far as the age of, again, we talked about baby boomers. You said you've got a guy who's 87.
Right, yeah.
Still working.
Yeah.
Actively working, right?
He loves it.
Okay. But
can't see himself ever retiring.
Warren Buffett's 90.
Yeah, something.
Yeah. But to that point, now you have an older population whom I helped refinance a few years ago to 2% interest rates. But now they're no longer capable of staying in a 2-story home. You know, bedrooms upstairs, living is downstairs. They got that 2% interest rate. They don't want to let it go, but at the same time, they can no longer live in that property. You know, this is an age issue where now you have to figure out what you're going to do as far as transitioning your life.
Yeah.
You know, when you get to 78 or 80 years old and you can't put a chairlift in the house and whatnot, you know, what are you going to do? You know, is that 2% interest rate really mean something to you? Right. It shouldn't mean as much as you being able to walk from your kitchen to your bedroom.
Right.
Right.
Yeah.
So I think in a lot of these a lot of these people in their situations, they've accumulated so much equity from having a low interest rate.
Yeah, they don't have
paying
to worry
down
about
so much principal.
They don't have to worry about it.
Yeah, exactly. So that's why some of these houses are coming on.
Let it go.
Yep.
That's really good. Headline from realestatenews.com. Spring is stirring. Touring activity of homes is up 23% since the beginning of the year. And homes for sale, if you typed in Google homes for sale, those Google searches have reached their highest level since last summer.
Okay.
Right now.
So people are looking.
So improving spring weather may also help be helping push a small increase in new listings. So there seems to be a demand, but maybe we need to, tread a little cautiously here. So we are seeing touring activity up. We are seeing higher Google searches. So we're seeing it, but maybe we're seeing that, but they're not necessarily pulling the trigger. Right. And I think that may go back to our first headline, the interest rate flux. I think people, again, anchor on the interest rate rather than the bigger picture.
Wait till the interest rate is 4 before I buy.
But
you're a fool if you.
Yeah. I mean,
you're killing yourself.
Right. Well, because
how much equity did you lose?
Yeah. Right. Because you're losing equity. We've already talked about there's homes on the market. You've got some negotiating power here. We've seen concessions from new home builders. Big concessions, new home builders, especially at the end of the year, right? Trying to
move their inventory, get it off the books.
Yeah. And some of them still have some inventory left from last year that they want to get rid of so they can move on to the next project.
Yep.
And so they have to have a certain percentage of home sales to do that. So I can see that there is this stirring, but this is maybe something, and we talked about this probably a couple of years ago on this show, that there is a normalization, an emotional normalization that happens when we just get comfortable with the interest rate, right? Because I remember when I got into real estate in the late 90s, right? Mid to late 90s when I got into real estate, right? Interest rates were around 7 to 7.5, right? And houses were flying off the market because people thought it was great compared to the 18%.
Compared to the 15% that it was before, sure, yeah.
And
I got into the market. I got into mortgages at the same time. It was a refi boom. I didn't even know what a refinance was. I got into the business so I could do, purchase. I was like ready to do purchases.
Right.
And I was doing refis at the same time. Yeah.
So, I mean, here's the thing. I think we've gotten far enough away, or we're at this beginning stage where we're getting far enough away from that 3% or less mortgage rate that we all recognize is not going to happen.
Not for another 80 years.
If it does happen ever again. But the point being, we start to habituate eventually to the mortgage rate.
Right. I mean, we're in a more normalized market.
Right.
Yeah. We're still slightly above a normal, again, you've seen the charts I've brought in the past, and we talk about 200 years of interest rates, and in a 200-year period of time, for the majority of that time, rates are at 6 or below. And really, even the majority of that time, they're at 5 or below. So we're still slightly above what a normalized rate market should look like.
Right.
Over the last 40 years, we've struggled to even figure out what a normalized rate market is because they spiked to 15, 16%.
Right.
When they spiked.
Right.
So now every time somebody sees something that's below 6, they're like, oh, that's great. Well, and then we went down to 2 and 3, and now anything above 4, they're freaking out.
Right.
They're too fixed on what that's going to do to their monthly payment more than anything else.
Yeah, this is the anchoring that happens is they get anchored there, and then they can't get past their anchor, and because they're not seeing the bigger picture.
Right. But you're talking about people who aren't afraid to go to a car lot and spend $800 a month on a vehicle.
Right.
Again, we can't compartmentalize the right things. A $3,200 a month house payment seems okay. If you say it's $3,500, they freak out, but they go to a car lot and they'll get an $800 car payment on a depreciating asset.
Right. Which makes no sense.
Correct. But humans have a hard time understanding.
Okay. Now you're stepping into my field of psychology.
Sorry, but it's relative.
Well, but it is because what we fail to recognize in ourselves is every purchase decision we make is an emotional one.
Pretty much.
Well, it requires emotion to trigger to say yes.
Yeah.
Right. And the problem is we're also emotional creatures in that we have a tendency to really want to focus on the car, and we're not worried about an $800, $900 a month payment or a fleece. you know,
and keep that car.
And yet you'll go, well, I can't afford the home. Well, listen,
you can afford that car, but you can't afford this home.
Why'd you get a new car?
Yeah.
When you drove it off the lot, you just lost almost 40% of your equity. And so the investment strategy is so emotional. So they got a brand new car which by the way,
might have been a low interest rate, whatever.
Low interest rate, but at a high monthly rate.
Oh yeah.
And then so then you go, well, I can't afford a house. Well, why don't you rethink this a little bit and go, you know what? I don't have to have the really nice new car.
Oh, shame on you for saying that to somebody.
Right. Well, but you know what? We started buying used vehicles years ago.
I've never bought a new vehicle ever.
Years and years ago, we went to buying used vehicles, by the way.
Yeah.
And you know what? It saves us so much money.
Yeah, ton of money.
And you know what? Now you can take that rest of that money and invest it in an appreciating asset. That's like home. So, you know, you're going, well, I really can't afford it because I got a car payment of $800.
Yeah.
Well, what if that car payment was $300?
That'd be a different story.
Right. Now, how much house can you afford?
So, you know, again, we might be a little off topic, but I'll explain this because it's important. You know, I get people that'll continually say, hey, I want to put down $70,000 on this house and blah, blah, blah. And then I'll look at their bills. I'll look at what they're putting out every month. And I'm like, why don't you just put down 3.5% to an FHA loan to acquire this property and then take $40,000 and pay off your $800 a month vehicle? Because if you put $40,000 down on the house, it'll only save you $320 a month. Meanwhile, if you put $40,000 on the vehicle, it saves you $800 a month. It makes you more centric to buy a house. You know, it alleviates your monthly debt load so you can afford that property better. Right?
That's really good.
Yeah. But it's a matter of trying to make them understand, you know, they're like, well, I didn't want to do that. I have zero interest on that car. I'm like, your car is a depreciating asset.
Right.
Your payment is X. Your payment is X. What does it matter what your interest rate is on that car when you're still paying $800 a month on it, when you could be paying a little bit more on the house, but a whole lot less than $800 more out of your pocket every month? You know, $500 would be the net positive back to you.
Well, that's what I'm saying. If you reduce that $800 payment to a $300 payment, right, and you want to have a house payment,
$16,000 used car,
and you want to have a $3,000 a month payment, right? Well, you could actually, if you reduce that car, now you can have a $3,500 a month payment, right?
Yeah,
because you save $500 on that vehicle.
You're saving the net positive.
So, and you're investing in an appreciating asset. Yeah. So really, really good stuff here. This is next headline comes from US Bank and their article on impact of interest rates on the housing market this week. Where you live matters more than ever. And so we live in Raleigh. So there are cities, Chicago, Cleveland, Milwaukee, are posting home price gains of 3.5 to 5% year over year up, while once hot markets like Miami, Tampa, Austin are dropping 4.6 to 6% year over year.
We talked about that, though.
National averages are meaningless right now. Your zip code is everything. Yeah. I think this is really, really important. We don't have to stay on this long, but I think what's really, really important is that if you're planning a move, right, before you plan move, even within a state, right? Because I would say if you pick zip codes, even within our area, okay, some zip codes are doing better than others in terms of equity year over year.
Sure.
Right.
Yeah. And 27601 will do better than 27615.
Right. Yeah. So for whatever the reasons are, but the point being is that if you're making a move, right, it would really behoove you, because we just talked about appreciating assets versus depreciating assets, right? It would really behoove you before you decide to pull a trigger on anything, find out do your research. Yeah. What is this market doing?
But you know what that tells me though is, and again, you have to think about it. If I have to choose from any place in the entire country, it's telling me, well, if I go to Milwaukee right now, I'm paying a 5% premium versus going to Miami now where there's a 3% discount.
Right.
So right now, Miami would be a buying opportunity.
Okay. So this is the other point. you hit the other point I was just about to hit on, and that is these markets change all the time. So what may be a down market today, this is where you got to look historically. And then, you know what? Let's be honest. Buying a house is like playing the stock market.
Right. It goes up, it goes down in value.
We can't predict the future of what your house is going to be worth.
Not always, but you can still look at like Raleigh itself. Our town, Raleigh is to me a bond market.
Right.
Meaning that it is a slow and steady increase in growth on an annual basis.
Right.
All right. New York is a stock market. Right. You can buy in there today, and then tomorrow it can shoot up by 50%, and then next week it can shoot down by 100%. It's literally, those markets are more volatile based on what goes on in those cities at those times, right?
Yeah, you're absolutely right. And I think this is why people need to, yes, you should be cautious, but also understand that you are playing the stock market. I don't know why this is coming in my head. My dad, when I was younger, he would say to me, I won't play the stock market because it's gambling. And I've always wanted to ask him, I said, why'd you buy a house? Because isn't that the same thing? Is that the same gamble?
Thing. Yeah.
So just kind of interesting there. Let's move on to our, I'm going to call it our last headline of the day.
Cutting me off. 50 minutes is enough for me.
Well, it's going to be an hour by the time we're done here. The lock-in effect is slowly thawing. More sellers are finally moving. This
goes back to them.
Yeah, well, this comes from Fox Business and Resi Club Analytics state inventory update. 80% of homeowners reporting a mortgage rate below 6%. The rate lock-in effect has left many with a strong sense of staying put. That's changing, albeit it has been over time. As life events such as job changes, growing families, retirement are finally overriding the reluctances to give up low rates. More sellers are entering the market means more choices for buyers.
But think about the amount of money and equity these people have gained in that period of time, and especially if they refinance to a 2% interest rate, and whether they maintain the old payment or not. Let's say they had a $3,000 a month payment, and then I refinanced them, and now their payment is $1,900 a month. But even if they split the difference and paid $2,500 a month, they have bammed down principal on that house. And that house has been a growing, appreciating asset the entire time, depending on what events, like you said, life events, right?
Yeah. There's a bunch of life events here. We talked about retirement, but you know what? People are having families again.
Right. What was the phrase that we used about 7-8 months ago? Remember, there was this thing called forced cohabitation.
Where
divorced couples or couples who are no longer wanting to be in their marriage.
Right.
They were forced to live together.
Right.
Because rates were too high.
Right.
Remember that?
Or that's what they blamed.
They said, I can't afford to go somewhere.
Right.
And I really don't want to live with Henry anymore.
Right.
Or whoever.
Right.
My point is that forced cohabitation situations are now, since rates are coming down,
starting to dissipate.
They're starting to say, okay, you know what? I feel like I'm in an area where I can afford to move out. Like there are so many of those factors, and again, I'm not trying to be an ageist, ageism, whatever. But again, when you're 75, 80 years old and you've lived in a 2-story home where the majority of sleeping space is upstairs on the 2nd story, it doesn't matter what the rate is anymore. Your life, your body is telling you that you need more.
Well, and then let's just dig into that a little bit further. Even if it's not the house, maybe it's just that you just don't want the lifestyle anymore.
Or, everybody's moved out of the house. You're the last person in there.
Look at you.
Yeah.
I've watched you send me pictures of, man, I could live in this.
I could live in Selma, Alabama, in this little town.
Selma, Alabama, in this little town. I could live there, right? And so, think about that for you because you're in your 50s.
Yeah.
And even for you, you're going, when you were in your 20s, 30s, that probably wasn't a thought at that time.
Didn't care as long as I was close to the town.
Right.
Again, my drug of choice at that time was action, adventure, excitement. Right.
So those things change.
Of course, our priorities change.
And this is what's
I'm old. I'm married.
Well, I think this is what happens is it depends on your lifestyle choices. Listen, I know a lot of older people who want to stay connected to the hustle and bustle of the city, right?
Sure.
Right. But for many people, and we're seeing a lot of them, they just want to get away.
Yeah.
They're done with it. You know what? I've spent my whole life working in the city.
I've served you humans. I'm done with
it. I've spent my whole life fighting traffic, sitting at lights, going through accidents, doing that every day for 30 years of my life or 25 years of my life. I've done that. I'm just done.
A barn dominium in Sampson County sounds like heaven right now.
Right. But then you've got that younger person, who's been in the city and loved the lifestyle. It was convenient to the clubs and everything. But now they got married.
Yeah.
And they got a family.
They got to figure out where to put the kid in school.
And they're starting to go,
schools are important.
This is not maybe the best place to raise my kid. This was great when I was single. It was great when we first got married.
That's right.
And we were having a lot of fun. But now that we're having a family, I'm not so sure that this is great anymore.
2 kids. I don't want them near this area. Yeah.
Right. And then, well, let's be honest. The job numbers are, good. I think relatively good. But here's the thing. We're seeing a lot of people change jobs.
Yeah.
Right. And, listen, when you and I actually moved from I moved from state to state.
Correct. I've never lived out of the state.
Right. You've never lived a state, but I was in Nebraska.
Yeah.
Knew I wanted to do better. So I went to grad school in Washington State, lived there, and then took my first job out of grad school here in Raleigh.
Yep.
Right. And
where?
So, I mean, but we're seeing this more frequently now that as people want to move up or they want to get better, or they want to do, there's more frequent job changes.
Yeah.
There is the days of the baby boomer staying with the same company.
Same company, 30 years.
Not happening. And get your gold Rolex. That's not happening. They're moving. So I can see why this lock effect is starting to thaw out a little bit.
Again, though, I personally believe the biggest thing is age change or familial change more than anything else.
Mm-hmm.
I feel like when a person gets in a certain, or even like, let's say that you bought the house together 40 years ago, you refinanced it, 5 years ago, and you and your spouse were both living. Well, let's say one of you have passed on at this point, 5 years later. Now you're living in that house by yourself.
Right.
Again, there's the change that you can't help,
Right.
and some people are like, I wander around this house by myself every day and I don't want to be in it anymore. There's a ton of scenarios that says it doesn't matter what this rate is.
Right.
I just don't want to be here.
Yeah, I agree with you. I'm going to throw one more headline.
Sure. Yeah.
And just to throw it in.
I'm batting 1,000.
You're killing it. This is from CNBC Real Estate. And they talk about renters are getting deals. Now, I thought that this is interesting. They say concessions.
Wait, why are we? This is a home buy. Whatever.
Well, it's because it's relative. It's relative, right? Concessions at a 10-year high, they're saying. I don't know if this is, and the reason I'm asking is because I don't know. I'm not in touch with that market. Maybe you're more in touch with it simply because you deal with people you've got people come from rental situations to buying situations. So you're dealing with that a little bit more directly than I am. So they're saying here that apartment concessions have hit their highest level in over a decade, particularly in the South and the West. So what does that ultimately mean for the housing market if we're starting to see some renter concessions?
Like everything, it depends. I mean, if you can ultimately turn around and buy a house for relatively, little money out of pocket, and your mortgage payment will be within a few $100s of where your rental payment is, I don't think that's really going to affect the housing. It's owning a house is always a mindset, especially for your first one.
I agree.
Like, hey, I've rented in town. I've been a renter for 5 or 6. I think I was a renter for 6 years myself before I was like, you know what? I am just giving money to humans who I've never met.
I'm paying somebody else's mortgage.
Why am I here?
Right.
And for me, it was a mindset. And I think for the majority of people, it's a mindset. They're like, hey, I'm doing well in my job. I got a great girlfriend or whatever, like it's time to go ahead and make some serious steps in my life. I don't think people intend to be renters for their entire existence. So
I agree with you. And I'm gonna tell you why I think that this might be a golden opportunity for those people who are listening, who are renting. If we're starting to see some renter concession, this is the best time for you to start saving some money. Right. If you're getting a little concession, and maybe you can negotiate somewhere.
I want to give you 1 month free or something.
Yeah, maybe give you a month free or a reduced deposit or whatever it is. This is a perfect place to start stockpiling some money away.
Put some money away.
So that you can now build some equity in a home. So if this is really true in the South and the West, and I don't have any reason to doubt.
If you want to give me, if I've been paying you an $1,800 a month rent for an apartment and you want me to stay here, I make it $1,500 a month.
Right.
If you make it $1,500 a month and I start saving $300 a month, then that's $3,600 that you've saved can go toward the down payment on a house. Yeah.
Right. And so now
that's the smart thing to do with it, by the way.
Right. I mean, you could put it in a 6-month money market account or CD or whatever it is, right, for 6 months.
Yep.
And just be contributing to that over the course of 6 months. Get a little bit higher interest rate. Maybe there's some other investments that you can possibly make with some of that money that are sound, safer investments instead of just letting it sit in a bank. Maybe, you can get some higher interest in other ways. But the point being is, if this is really true, then this to me says, okay, renter, right? You can negotiate maybe a free month or two, or maybe you're negotiating a little bit lower price. Take that money, put aside. You're now going to get faster to your dream of home ownership, which, by the way, as we've talked about through the entire show, that's equity.
Yep. Or take that $300 a month and pay it down on your car and try to pay your car off so you don't have a car payment by the time.
And
something,
right?
Yeah.
Get rid of debt.
Yeah.
Right. Perfect opportunity to
get rid of debt is one of the biggest things I would tell anybody. But
right. Well, I mean, if you're renting, right, the big thing is get rid of your debt.
Yeah.
Right. It's the big thing. We've done an hour. This has been a lot of fun.
I made it. I got all the questions right.
Well, I know.
How would you grade it?
No, I mean, it was fun.
This is plus.
We've never. This is the first time you and I have done it.
Yeah.
But I thought it was pretty fun.
I think it was.
I enjoyed this.
Yeah. No, always a great show. Always a good
Well,
time.
I know, but we've never done headlines, and we've never done this before. And I had said that, you know what, if I don't have a guest that's doing something special, I said, why don't we just do the headlines of the week?
Yeah, why not?
And so
we can do this once a month.
I probably will be calling you. Well, maybe happen more than once a month.
You're like, what are we doing next week? Oh, we're doing the show.
Well,
I mean, 10 more headlines.
I have listened to other real estate shows, and they do headlines of the week. And I was listening to them, and I was talking to Linda, and I said to her, you know what, we could do that.
Oh yeah.
And I said, I actually think we're better.
Oh yeah.
No offense, but
we definitely bring more flavor, more flair.
I think
more personality.
I personally think we're better.
Yeah.
So,
I think
so. No offense. No offense to my colleagues, real estate folks doing your podcast. I think we're better.
Yeah.
So
you guys suck.
Yeah. That's not what I said. I just think we're better. Paul, thanks for joining. Tell people how they get a hold of you.
Thank you, brother.
Yeah.
Again, my name is Paul Fitz. And if you want to reach me, you can call me anytime. My cell phone is 919-612-0043. That's 919-612-0043. Or email me at PFITTS. That's PFitz at advantagelending.com. I'll be glad to help you out, take your questions, tell you what I feel like is going on in the rate market. Any way I can help you, I'll be glad to do it.
Thank you for doing this, folks. We're finishing the show. Here's the thing. You had a lot of choices. You chose us. Thanks for doing that with us. you're on YouTube watching the show, thumbs up, please subscribe,
like and share.
We and share it. You're listening to us by podcast, wherever that is. I don't care, Apple, Spotify, wherever you're listening to. We're on all of them. 5-star review, please, and tell your friends. It's awesome. So I say to you all over the world, you know what that is. Thanks for joining us, and ciao, everybody.